Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 46 on January the 26th of 2019. I'm your host, Eric, and in this week's show, we will cover the trades from last week on Vodafone, Twitter, and eBay, and we discuss three new trades on Cleveland Cliffs, Haliburton, and Texas Instruments. It's always great to hear from listeners, so if you have any questions about the trades on the show or about any of your own positions, feel free to email me. You can reach me at eric@theweeklyoption.com. That's ERIC at theweeklyoption.com. And I've also created a short video series to teach you all of the basics of option trading so that you can follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit us on YouTube. You can find the channel for the Weekly Option. Been an interesting first couple of weeks of the year. I've been keeping an eye on politics given the shutdown news over the last month or so, and any news about trade wars. I just want to make sure you guys know it's important. I don't like politics at all. I'd much rather talk about business, but it's important to consider the economic effects of all of the various political decisions that are happening. So as an economics major in undergrad, we always looked at how one change affects all of the other factors in the economy. So whether it's changes in trade agreements like tariffs or personal income, consumer spending and consumer sentiment, government spending, changes in the interest rates, like all of that has an effect on the domestic and possibly even the global economy. So the equity markets actually finished essentially unchanged, recovering from the lower levels that it saw midweek of this past week. So the Dow Jones Industrial average gained 30 points week over week, ending the week at 24,737 points. The S&P 500 index dropped nearly 6 points to end the week at 2,664 points. Both of these indexes changed less than 0.25% week over week, so it was pretty much a nothing move week over week, while there was some midweek volatility. Now, there are 466 publicly traded companies in the U.S. that will announce quarterly earnings this week. On Monday, Caterpillar, Aetna, and Shutterfly will announce earnings. On Tuesday, I'll be looking for 3M, Apple, Amgen, Advanced Micro Devices, Lockheed Martin, Verizon, and eBay to announce earnings. On Wednesday, we'll hear from AT&T, Boeing, Microsoft, Facebook, SiriusXM, Visa, Tesla, and PayPal. Thursday, we'll bring earnings reports from Amazon, Altria Group, Sprint, General Electric, ConocoPhillips, Valero, International Paper, Northrop Grumman, Dow, DuPont, and MasterCard. And then we'll finish up this week looking for earnings reports from ExxonMobil, Booz Allen, Chevron, Merck, KKR, Honeywell, and LyondellBasell. So it's going to be a pretty busy week on the earnings front, and it's definitely good to keep an eye on that as far as fundamental data goes for equity markets. This week, the topic of the week is all about planning the trade and trading the plan. And if you guys have been around the trading world for any amount of time, I'm sure you've heard that saying, plan the trade and trade the plan. And there are positives and negatives to this. So let's go through some of those. So the positives, I always like to do research. I mean, you can't just get out there and kind of shoot from the hip. Especially when you're talking about options, because I always want to know any changes in the market that might be coming ahead, such as earnings reports, dividends can be important, any news from the industry. You just want to make sure that you're aware of things that could affect the underlying stock or the underlying, whatever underlying you're trading options on. And so I always start with a process of research and analysis that also includes technical analysis. I look at some things. So I want to plan out my trade just to even find the trade. I do quite a bit of research. And then there's also things that you can't plan for, which are like slippage, slippage in execution. So maybe you intend to buy a spread for 15 cents and you actually end up paying 16 cents, or you're able to get it for 14 cents. Like there's slippage in pricing sometimes that you just can't plan for. So I try to plan for everything that I can plan. Um, Part of that is creating a plan B. So I always know the parameters that I like to trade. I call that plan A. Plan B is what happens in reality. So plan B is what happens when you expect the market to go higher and it actually goes lower. Or maybe you thought you'd be able to execute the trade at one point and you actually had to get a little bit worse fill in order to just go ahead and get in the game, get in the trade. So having a plan B on what happens if you execute at a different price, your option strategy, as well as what happens if the stock price doesn't go in your favor, is really important. And you guys hear me talk about this almost every week because not all of my trades win from the start. In fact, just a little forewarning, the covered call today, we're going to end up having to talk about plan B a little bit. And that's why it's so important to understand your break-even point in options, because if you have an idea of where your position actually makes and loses money, and you know your break-even points, your before you even get in the trade, then that gives you a good idea to say, if price doesn't move here, even if the option moves against me a little bit, I'm still going to stay in this trade. But if we get past this point or get near that point, I have to decide what I'm going to do. Am I going to trade another option strategy against the one that I started off with? Or am I going to exit the position? Or maybe I'm going to do something with the underlying stock. So the better you understand options in general, the better you'll be able to create that plan B. And I mean, I've done it time and time again, and spoken about it as well, where you have a trade that ends up going against you from the start, but then you go with plan B, and plan B ends up making you even more money. So it can happen. That's why I do this show every week and try and talk through my trades, is so that you guys get to hear how a trader actually thinks about not just making money, but keeping the money that you planned on making, right? It's like at the start of a trade, we have a theoretical idea of the money we're going to make. And then we execute that trade. And from the moment we execute, you start getting real data, real movement in the options, real movement in the underlying stock. And that lets you know whether you're really making money versus that theoretical price or that theoretical profit that you thought. And so from the start with the options, you can have a plan, a trading plan. And that's also why each week I talk about things like maximum loss and maximum gain. I mentioned maximum loss when we sell something. And I talk about maximum loss only when we sell, because we get our maximum gain the moment we sell that option, right? So if you sell an option, the most you're ever going to make is the amount that you receive for selling that option or option spread. And so what we have to talk about is the maximum loss that you could incur. When I buy an option, I talk about my maximum gain, because the moment I buy an option, I have incurred the most money that I could ever lose. You can't lose more than you pay for that option when you purchase an option. So right from the start, I know all of my numbers, all of my metrics, my break even, my maximum loss and gain, and it lets me decide from the start, before the stock price moves in my favor or against me. I already know what my options will be, what my plan A is, plan B, and I'm able to not only plan the trade, but I'm also able to trade the plan with a little bit more confidence. So that's it for this week. Let's go ahead and review the topics, or the not topics. Let's review the trades from last week. So I already told you up front that this Vodafone, this covered call trade did not go my way. But we looked last week at Vodafone, symbol VOD, Victor Oscar David. The stock at the time was trading for $19.30. And we looked at selling against that stock, the February 20 call at 32 cents, and that would have created a 5.28% return in 4 weeks. Now, Vodafone stock fell $1.33 per share, ending the week at $17.97. The call option we sold last week for 32 cents can now be repurchased for 4 cents. That will lock in a 28-cent profit on the option. However, that's not enough to offset the loss that you took in the stock price fall of $1.33. So as long as my long-term listeners know, I like to roll the strikes lower if the stock price has fallen in a covered call position. That means we look to recoup some of the losses in the stock by locking in profit on the original option, by buying that back and then selling another option, typically the current at the money option, because stock has gone lower. So right now you can sell the February 18 call for 43 cents. And that adding the premium from this option, this new February 18 call, adding that premium together with the profit from the option last week, that would be 28 cents plus 43 cents. That gives us a total of 73 cents per share. So by rolling the strike lower, you lower your current loss. Like right now, we have a current total loss of $1.01. We lower that down to 60 cents by 60 cents per share. Or you can choose to do nothing, but the stock can continue to fall against you. So that leaves you exposed. That's the biggest problem with covered calls, is that the stock that you own can continue to move against you. So we can also, of course, hope that price rises again and that stock goes back up. But in general, hope is a bad trading strategy, in my opinion. So I like to do something in my options if I'm going to stay in the position. And or you can overall decide, this is the most that I'm willing to lose on this, and I'm going to just go ahead and sell the stock and go ahead and buy in the option. And if you did that, you would walk away with a $1.01 loss on this. Now, our second trade of the week is the credit spread. Last week, we looked at Twitter, symbol TWTR, Thomas William Thomas Richard. The stock at the time was $33.27, and we looked at selling the February 32-31 put spread at 34 cents, which creates a maximum loss of 66 cents per spread. Now, Twitter stock fell 37 cents per share, finishing the week at $32.90. This means that the out-of-the-money put spread we sold is actually a little bit closer to being in the money now. The spread that we sold for 34 cents could actually be repurchased for 44 cents per spread, which would incur a loss of 10 cents per spread. And that loss of 10 cents isn't enough to get super worried about right now. However, there's another 56 cents that could be lost in this trade. So you'll have to take a closer look at the stock to see whether you want to stay in this trade or if you want to exit. Now, I like to turn to the break-even point for some help. The stock price is still above the break-even point in this situation, and it appears to be maintaining a little bit of strength right here. So I'll stay in the trade a little bit longer and make a decision after a few more days of stock movement. We still have 3 weeks left until February expiration, and this stock could very well pull a bit higher, especially given some of the news over the last the last few days. So if the stock pulls higher and this spread remains out of the money, we'll be perfectly fine. So our final trade from last week was the debit spread. We looked at eBay. The symbol is exactly the spelling of the stock, EBAY, Edward Brian Adam Yellow. Stock last week was trading for $31 even, and we looked at the February 30-31 call spread, purchasing that for 65 cents, which creates a maximum gain of 35 cents, or roughly 53% return on our at-risk capital. Now, eBay stock rose $2.72 this week, so it finished up the week at $33.72 per share. And the in-the-money call spread, which we purchased, is even more in the money at this point. So one of the options in the spread has a wide market. So getting a definite, like a solid exit price is a bit of a challenge. But I'm betting the spread could be sold right now for roughly 90 cents, which would give you a roughly 38% return on your risk capital in 1 week. So, of course, we're roughly $3 away from our break even price. eBay will announce earnings this week, so that's always something to be aware of and to keep track of. So, as long as the stock price doesn't fall by 10% over the next 3 weeks, this spread will expire being valued at $1, which means that we get to maintain or we actually get to collect that 35 cents maximum gain or 50%, 53% return on our capital. So I'm going to hang on to this one a little bit longer and see how it turns out. But if they announce earnings and the stock falls quickly, I will look to exit this as quickly as I can. Just go ahead and dive into this week's trades. This week, I do like the trades that I'm presenting. Two of them actually had earnings last week, and I like that. So there shouldn't be any additional news that will affect those. One of them is still a little questionable, but overall I like it. And the one that's questionable is going to be our covered call. We're looking at Cleveland Cliffs, symbol CLF, Charles Larry Frederick. The stock finished the week at $9.61, and I'm looking at owning that stock and then selling the February 10 call at 41 cents. Now that creates an 8.32%, really an 8% return in 3 weeks, so that's great. You would enter this trade by buying CLF stock for $9.61 and then looking to sell that February 10 call at 41 cents per option. The only question I have about this, and this company's been doing great, it's a steel stock, and so they are significantly affected by trade agreements, tariffs, and the possibility. There's been a little bit of a hint at slowing demand for steel in China, and that's the other problem that happens is when tariffs happen, you also you end up in a situation where it gives rise to other substitutes. So products that may have used steel before will start to use other things, other substitutes, or lower valued metal mixes to accomplish the same, to create the product and still be able to supply that demand. But what happens is that the demand in the original product will decrease because you've increased the demand for substitute goods. So sorry to bring economics back into this, but that's kind of what I'm looking at on this Cleveland Cliffs. Again, this is a 3-week trade. I think this could do very well. And if we see some lessening of tariffs, which is not unlikely right now, I think the president could go for some wins by improving the global outlook on trade. If you lift any of those tariffs, I think Cleveland Cliffs stock will benefit, and that'll let us capture that 8% return in the next few weeks. Now, as far as the credit spread, I'm looking at Haliburton, symbol HAL, Howard, Apple, Larry. Stock ended the week at $32.10, and I'm looking at selling a February 32.31.5 put spread at 17 cents per spread, and that creates a maximum loss of 33 cents. Now you enter this trade by selling the February 32 put at 83 cents and buying the February 31 half put for 66 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices stay above $32 per share over the next few weeks. Haliburton actually has some strength after its earnings, and I think it'll stay there unless we hear, of course, we've got Exxon announcing this upcoming week. So if Exxon announces poorly, then that'll affect this Haliburton stock. Otherwise, I'm expecting Haliburton to maintain some strength and hoping that this put spread to remain out of the money so that we can keep our 17 cents. And then the final trade for the week is going to be a debit spread on Texas Instruments. Texas Instruments, symbol TXN, Thomas X-Ray Nancy. The stock finished the week for $104.41. And I'm looking at buying the February 103-104 call spread and paying 63 cents for this. It's slightly in the money, and it's in the money right now, and that creates a maximum gain of 37 cents or a 58.73% possible return in 3 weeks. Now you enter this trade by buying the February 103 call for $2.85 and selling the February 104 call at $2.22. This is a debit spread because we are buying the spread. We're buying the lower strike call spread. This trade makes the most possible money if stock prices stay above $104 per share. And that's it. That's all I've got for you this week. Again, if you have any questions, feel free to email me at eric@theweeklyoption.com. Have a great week and a great weekend. Happy trading. Take care. Bye-bye. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.